Duration is the other key. We talked about the dollar first. Dollar softening. This is exactly what you expect going into the trough of a credit cycle. Usually you see some sort of easing hitting the dollar. This is the duration chart of the May 2050 bond. I like to cover this one rather than the just the 30-year long bond Treasury yield, because I think the price chart on this bond, from a signaling standpoint, packs in so much more information where you just have price to go off of rather than yield on a bond, which can has a lot of adjustments you need to take into effect to really see the trends. The key thing this week, so there's a dotted green line. It might appear kind of solid, sloping downward from top left to bottom right. That was the prior top of the channel resistance, if you will, for the price of this 1.25 coupon Treasury bond that the government was able to issue in May of 2020. Lowest coupon bond on the 30-year ever to launch in the Treasury market. So we clearly at this point, after kind of poking our heads up through that resistance line, it's set further back on the chart. I zoomed in on the most recent 2 years to really get a sense of what's going on. That bond is signaling a breakout against that long-term downtrend. And so when I talked in prior weeks about we were looking for a very clear signal to tell, if you look at the channel that's highlighted in blue, that's the uptrend channel that's starting to very clearly take form for long-term duration over the trailing year. What we were looking to prior to this week, like the last time we've met, we've been talking about on the times we've opened the show looking at duration. We were waiting for this market to clarify direction on which way long-term Treasury rates were going to go, and where the long-term rates go will help inform. It'll pull the rest of the curve, from the belly along with. Now they won't go exactly in unison as we've kind of seen today, and the yield curve charts we showed just a second ago. But the trend looks like we've come out of that wedge. We've broken to the upside, which suggests that treasuries are going to continue to see a supportive bid. How long this lasts is always TBD. These trends can break down. But to me, it looks like we've broken to the upside in price for long-term Treasury bonds, which the other side of the coin on that means yields want to come lower, right? And that jives with what you see on the front of the curve. Overnight rates, short-term rates, Fed funds, etc., they want to come in. They're saying, hey, is there 75 bips of cuts, 100 bips of cuts? The front end's going to come in. Belly has already seen a tremendous rally. What this looks to me like is long-term rates are showing their hand here, that treasuries want to come in response to the policy steps that this administration is taking. To take them at their word, this is what they said they wanted to do. Markets are now starting to signal that that's what they're going to get. Now there is some reluctance. If you'll notice, every candle on this breakout, the daily headline, the last 3 days has pushed yields further and further above that green resistance line, but they've always been sold off in the market session. We saw it today too. The 30-year today closed not quite at its intraday low, but they didn't close you're not seeing a close into strength, like a close into another high. So maybe there is, we've got an NFP jobs report coming tomorrow. We've got other data, other, shoes to drop. These tariffs go into effect on March 9th. I'm sure there will be other headlines in between. So don't be surprised if you see some softness and or some of the yield given back in long-term Treasury rates. But if you're preparing your investment outlook for the year ahead, the remainder of 2025, this is when you don't swim upstream in the river, right? Follow the current, and the current says Treasury rates want to come in.